Hello and welcome. My name is Ed Newton with Newton Wealth Management. We put these podcasts together to help you as you continue along the path to achieve and maintain a worry-free retirement. We hope you'll enjoy this one and find it beneficial. I know it's been a couple of weeks since I recorded a podcast, so I wanted to take this time to give you an update on our outlook for the rest of this year and into 2021. In December 2018, with the S&P 500 at 2,500, we forecast it would hit 3,100 by the end of 2019 and then pushed our forecast to 3,250 as stocks soared during the year. The S&P 500 rose 28.9% in 2019 and hit our revised target on the first day of trading in 2020. We then raised our target to 3,650 for the end of the year 2020, and the way stocks were moving higher in January and February made that forecast look very reasonable. But then the world took a detour into the coronavirus contraction. As a result, we are adjusting our year-end 2020 target down to 3,100, with the Dow Jones Industrials average finishing at 25,750. That would be a moderate gain of 5.8% from Friday, May the 8th's close. The range of plausible outcomes for the rest of 2020 is very wide right now. The key variables include factors that are normally irrelevant to forecasting markets, such as the spread of the coronavirus, how quickly the economy opens, the development of therapies or a vaccine to fight the disease, and how quickly people are willing to get back to normal. With the economy getting crushed, some analysts are wondering how equities could have bounced so hard from the March lows. We understand that confusion. With the unemployment rate likely above 15% and real GDP falling roughly 30% in Q2, how can equities be doing so well? We believe that one key to understanding this is that investors don't buy shares of the GDP. They buy ownership stakes in a distinct set of companies, many of which are doing quite well despite the general economic carnage. Imagine a company that has a major competitor nearby. One day, completely out of the blue, the competitor's facilities are all destroyed by a meteor. Obviously, no one would celebrate this catastrophe. However, when competitors go away, the enterprise value of the surviving company rises, and you don't have to be an astrophysicist to figure that out. In many ways, the spread of the coronavirus has given larger, well-capitalized companies, particularly technology companies and big-box stores that were allowed to stay open, an advantage over Main Street competitors. And unlike Main Street businesses, a larger share of these companies are publicly traded. Meanwhile, our capitalized profits model for equities based on profits and interest rates suggests a 3,100 level for the S&P 500 would not be overvalued. To put this in context, a 3,100 level assumes that profits fall by 60% and the yield on the 10-year Treasury note climbs to 1.25%. We forecast profits will fall about 25% this year, and the 10-year Treasury will rise to just 0.9% by year-end. In other words, even at 3,100, we believe the S&P 500 will still be undervalued. And with profits rising in 2021, we think the S&P 500 can then rise to 3,650 a year later than we originally forecast. One reason to be bullish on equities is that these days quantitative easing by the Federal Reserve is going straight into the M2 money supply and not into excess reserves. In the past 3 months, M2 has climbed at a 66% annualized rate, the fastest rate we know of in history. Meanwhile, the federal government has ramped up deficit spending, with unemployment insurance and loans and grants to small businesses, to try to offset the private sector losses in income. Regardless of what we think of these policies, the effect will be to support equity prices in the year ahead. We hope this information has been helpful. If there's anything we can do at Newton Wealth Management, please don't hesitate to give us a call. We hope this information has been useful to you. Our goal at Newton Wealth Management is to help clients achieve and maintain a worry-free retirement. We are a fee-only firm. That means we don't receive commissions or any other compensation from the investments that we utilize. We have a fiduciary responsibility to our clients, which means that we always put your interests first. If you haven't set a plan or not sure that your plan is appropriate for your goals, we would be happy to talk with you and see if there's anything we can do in order to get you on track so that you too can achieve and maintain a worry-free retirement. If you have $250,000 or more of investable assets, I would invite you to visit our website at www.NewtonWealthManagement.com. There you can find out more about our firm and the services we offer. Again, the website is www.NewtonWealthManagement.com. From the website, you can also contact us to request a no-obligation, no-fee consultation. We look forward to hearing from you at www.NewtonWealthManagement.com. Newton Wealth Management is responsible for the content of this podcast and reflects the current opinion of the speakers. It is based upon sources and data believed to be accurate and reliable. Opinions and forward-looking statements expressed are subject to change without notice. Securities offered through Archer Investment Corporation. This information does not constitute a solicitation or an offer to buy or sell any security. A risk of loss is involved with investments in stock markets. The commentary provided should not be regarded as personal investment advice. Past performance is no guarantee of future results. You should carefully consider investment actions in light of your goals, objectives, cash flow needs, and time horizon.